Let me bring on board William D. Wilder, Chief Investment Officer with PNB Paribas Investment Partners. William, good morning. Thank you for joining us. Great to have you back on ET Now. William, the key question or the key moot point is that after, do you think the current phase of risk-on rally will continue? Because the risk-on rally clearly has been on for 2 months. Do you think it will extend for another 2 months?
Yes, I think trend-wise it will continue. Investors are kind of struggling to find a negative catalyst, which is a bit scary in a way. I think if you would look for the candidates, there is of course the political situation in Italy. And I think what also could come to the forefront of investors' mind is as you get closer to the deadline for increasing the debt ceiling in the US, that could cause some nervousness in the markets. But what you see is that investors are looking for more yield, for more return, and that is something that will not change. It will just continue.
William, hi, morning. You think political and policy decision will continue to play an important role in the swings in investor sentiment? And what are the key things that you're watching out for?
What's interesting is that recently policy decisions have not had a big impact. Politics in Italy had a negative impact on global risk appetite, on investor sentiment, which lasted something like 1 day. And although today we have no more clarity in which direction it would be going, it's still not having an impact on markets across the board, although clearly Italian yields have been moving up a bit. The same thing in the US. We have no clarity whatsoever on what is going to happen with the sequestration, whether these measures are going to be turned back, nor do we know what kind of deal will come out that will allow to increase the debt ceiling, but also to have a better grip on the budget deficit. All these things do not seem to have a big impact on the minds of investors. Although, of course, if this situation would just go on and on, meaning no clarity in Italy, no clarity in Washington, eventually it would have more of an impact, of course.
William, you track emerging markets so closely. Is there still some steam left, or do you see now some weakness trickle in for the emerging market pack, especially India?
Well, emerging equities are suffering from the kind of an absence of a big positive driver. When you're looking at specific countries, you do see markets that have been doing very well. I think there has been the ongoing disappointment kind of the cyclical environment in China, where although the soft landing that was talked about so much in the first 9 to 10 months of 2012 has succeeded, and although the feeling is okay, the country should be able to grow between 7 and 7.5%, the market has reacted very negatively to efforts to rein in property speculation. Then there's also talk about credit overhang and so on. At the same time, when you look at other countries than China, what you see is that the growth performance, GDP growth performance compared to the history of these markets, of these countries, is rather disappointing. You see that in Brazil, for instance, but also in other countries. And then what also is the case is that people are, of course, enthusiastic about the dynamics that you see in the US, and that is then pulling in a lot of money, investor money, and some other countries are benefiting from that. The Eurozone has benefited because the ECB has introduced the tail risk protection, the outright monetary transactions, back in September last year. And now Japan is trying to get its piece of the cake by embarking on an aggressive monetary policy in a non-conventional way. So all these things show that in a number of developed markets, developed economies, there are some attractive points, and this is also on a relative basis weighing on emerging equities as a whole, although some of them are benefiting from investor interest clearly.
William, what about India? Were you disappointed by the budget, or you feel reforms will continue outside of the budget?
Well, I think reforms will continue and have to continue, and there's just no choice there. And okay, the opportunity is so huge, so it would be a shame if it were not to continue. I think what you have with the budget is that it is, in our view, based on rather, well, aggressive assumptions. And using these aggressive assumptions, you end up with a figure slightly below 5%. Now, because the assumptions are rather aggressive, there is, of course, the risk that we would not get there. Does that mean that it would deal a big blow to market confidence? Not necessarily, but it is something that requires attention, vigilance, because it is simply too high. Admittedly, the economy is growing in real terms at around 5%, and then you add the inflation. So when you look at the budget deficit compared to nominal growth, there's nothing to be worried about. But on the other hand, having a 5% budget deficit is on the high side.